Trade threats and data risks. Can the UK withstand the pressure? President Trump's latest tariff threat over Greenland is a blunt reminder no trade deal is ever final. The UK has so far dodged the worst of the tariffs, but that could change fast, with Trump planning a 10% tariff starting in February. At the same time, UK markets are off to a strong start this year, but upcoming data will put that to the test. So can the UK economy still outrun the risks? Dani Stoilova is Europe economist for BNP Paribas Markets 360. So Dani, let's start with Trump's latest tariff threat. Levies rising to 25% in June. That's unless a deal over Greenland is reached. So how damaging would that be for the UK economy?
I want to preface my answer by saying that there is still a little bit of uncertainty around the exact implementation of these tariffs that were mentioned over the weekend, including due to the looming Supreme Court decision on the International Emergency Economic Powers Act. However, if we take these tariff threats at face value and if we assume that an additional 10% will be applied on all UK goods, our modeling suggests that this would be a hit of 0.1 to 0.2% on the level of UK GDP. But that's just the direct impact of the tariffs themselves. There are other factors to consider, including if there's a rise in uncertainty that can impact business sentiment and consumer decisions, as well as if there's any retaliation coming from the UK or other European countries. So we'll definitely be on the lookout for more detail on these factors before we embed anything in our base case over the next few weeks.
Well, let's turn to the upcoming data now, and inflation is expected to pick up in December after a sharp fall in November, but the Bank of England has warned about this. So do you see meaningful disinflation ahead?
Indeed, we do expect to see a marginal pickup in the headline inflation rate in December to 3.3% year on year. But we ultimately think that this will be short-lived and that there is disinflation ahead. In fact, we think that by the middle of 2026, we'll be hovering around the BOE's 2% inflation target. And that's the result of a few very fundamental things, including first, the ongoing cooling that we've seen in the labor market passing through onto wage growth, base effects and services inflation, including due to water bills, and finally, some of these impacts that we've seen on the autumn budget, including the removal of energy levies from household energy bills. So definitely think that the story ahead is one of disinflation, and it should be supportive for further BOE easing ahead.
So let's look closer at the employment reports. And do you expect Tuesday's unemployment data to confirm that the jobs market is losing momentum?
Thank you for the question, Peter. I think the cooling that we've seen in the labor market so far has really been a necessary prerequisite to bring down domestic inflationary pressures. And what will matter from here is whether we see this cooling in the labor market continue, exacerbate, or if we stabilize around current levels. Our base case is really the latter, that we stabilize with unemployment around that 5.1% level and that we start to see a little bit of an improvement in the latter half of the year. However, if we do enter this risk case scenario where labor market cooling goes beyond what we expect, then that really does risk taking us into a more disinflationary territory. And that opens the door to potentially even more easing from the Bank of England.
Well, as you said, with more easing from the Bank of England being priced in, how much do you expect this year? And could renewed tariff risks accelerate that shift?
We have a slightly out of consensus view on the Bank of England. We do expect one more rate cut this year in March for a temporary terminal rate of 3.5%. And after that point, we expect the BOE to deliver a bit of a prolonged pause until it has very clear evidence that these inflationary pressures have subsided. We think that it will have that evidence by the turn of the new year. And so we expect the BOE to resume easing in Q1 2027 and to cut two more times for a true terminal rate of 3% by the middle of next year.
Well, Dani, let's finish with sterling, and hedge funds have built up bullish bets on sterling in recent weeks, but the pound does tend to struggle in risk-off episodes. Should we expect weakness ahead?
Peter, you're exactly right that sterling tends to be seen as a high beta currency. So when equities underperform, sterling tends to as well. And in fact, our FX strategy team here does see scope for a little bit more weakness in sterling, particularly against the euro. But this extends beyond just this near-term risk-off story and ties back into the fundamentals. And one of these fundamentals that really is going to impact this is interest rate differentials. So while I just mentioned that we expect the BOE to continue easing all the way into 2027, we think that the ECB is actually going to stay on hold for the foreseeable future and resume actually hiking rates in 2027. So this is something that it should play a big role in in the sterling weakness that we expect ahead, more than just the short-term news flow.
That was Dani Stoilova from BNP Paribas Markets 360. Don't forget, you can watch more videos on Reuters.com.